Welcome back to the Deep Dive. Today, we are taking a hard look at a stack of earnings data that really tells a very specific story. A story about the American consumer, about global trade, and just the sheer cost of doing business right now.
It's good to be here. And honestly, this feels like a reality check for the entire consumer staples sector. We're not just talking about a quarterly miss here. We're talking about, a structural shift in expectations.
We certainly are. We're breaking down McCormick & Company, ticker MDIKC. And I have to say, the immediate sentiment on the street was, frigid.
Frigid is a good word for it.
We saw a huge hit to the stock. It dropped to about 8.4%, down to around that $61 level. For a safe, low beta stock like a spice maker to shed nearly 9% in a day.
That's not normal volatility. That is a repricing event. It's a harsh reaction, but it's a rational one.
Right.
You're seeing this classic friction point. You've got a company that's actually, doing surprisingly well on the top line, selling more stuff.
Mm-hmm.
But that performance is just colliding head on with a wall of costs, tariffs, margin compression, and then the guidance that just completely decoupled from what Wall Street was expecting.
And that's the why behind the drop. So let's dig into the headline numbers from their Q4 fiscal 25. I was looking at revenue, net sales, and it actually came in at $1.85 billion. That's up 3% year over year.
And crucially, that was a beat. Consensus was sitting around $1.84 billion. So against a backdrop where a lot of food companies are reporting shrinking sales, McCormick actually sold more than expected.
Right, people are still cooking. But then my eyes drift down to earnings per share, and that's where you start to see the red ink. Non-GAAP EPS landed at 86 cents.
Now that is up from 80 cents the prior year, so there is growth.
But the fact set consensus was 88 cents. They came in 2 cents light.
And in this market, missing by 2 pennies when you're trading at a premium multiple is a problem. But the real issue, the thing that I think really triggered the sell-off, was the margins.
Oh, yeah. Adjusted gross margin dropped 120 basis points, down to 39.0%.
That is a massive contraction for a mature business like this. The whole investment thesis for McCormick is their pricing power. They're supposed to be able to pass on costs. This suggests that moat is a little shallower than investors thought.
Or the costs are rising even faster than they can pass them on. And it wasn't just a backward-looking problem, was it? The guidance for 2026 was the primary catalyst.
The guidance was a shock. They put out a number of $3.35 to $3.13 for FY26 EPS.
And the street was sitting up at $3.21. I mean, that's not a miss, that's a chasm.
It's a huge gap. You're talking about a guide that's basically flat to down versus what analysts were modeling for growth. So even though they raised the dividend again.
Right, the dividend aristocrat status, 40th consecutive increase.
It just didn't matter. The market was pricing in a margin recovery story for 2026, and management basically came out and said, not yet.
Okay, so let's figure out why. Why is that recovery delayed? Looking at the transcript, a huge part of this squeeze seems to be coming from tariffs.
Tariffs are the headline friction, for sure. Marcos Gabriel, the CFO, he gave a really detailed update on this. And interestingly, the total exposure number actually went down.
I saw that. They updated their gross annualized exposure to about $70 million, down from a previous estimate of $140 million. So if the exposure was cut in half, why is the cost impact for 2026 so high? They're projecting a $50 million incremental cost.
It comes down to inventory accounting and timing. Just because a tariff gets announced today doesn't mean it hits your cost of goods sold tomorrow.
Oh, okay.
It hits when the inventory that was subject to that tariff actually flows through the P&L. So even though the total theoretical exposure dropped, the timing of the cash impact is landing squarely in 2026.
So the bill is just coming due now.
Exactly. And while they have plans, surgical pricing, changing sourcing, offsetting a $50 million headwind just to get back to flat is a heavy lift.
And it's not just tariffs. They mentioned commodity inflation was higher than expected in Q4.
Yeah, and you have to remember, their supply chain is a logistical spider web. We're talking 17,000 different ingredients from 80 countries. So even if inflation is cooling here, if the price of vanilla in Madagascar is going up, they feel it.
So their outlook is for mid-single-digit inflation to continue.
It is. The cost of the raw stuff is still climbing.
Then there's the, what I call the self-inflicted wound, the ERP implementation.
Or the necessary evil, maybe. They decided to accelerate it, consolidate the rollout waves.
Okay, so instead of doing it piece by piece over a few years, they're deciding to just rip the Band-Aid off.
That's the gist. Strategically, you can argue for it. You get to the benefits faster.
Yeah.
But financially, it pulls a ton of cost into 2026 that wasn't in the original plan.
And that just depresses those short-term margins even further.
Yeah.
So you have tariffs, inflation, and a massive tech project all hitting the P&L at once.
It's a perfect storm of costs. And we haven't even gotten to the biggest noisemaker in the whole report,
McCormick de Mexico.
the McCormick de Mexico transformation.
This is a fascinating piece of financial engineering. On January 2nd, 2026, they closed on buying the controlling interest. Basically, they bought out their partner.
And this is huge for optics. This one deal is expected to add 11 to 13% to their sales growth in fiscal 26.
Which explains why the top-line guidance looks so good, right? Double-digit growth.
Exactly.
But it feels like an optical illusion. If I'm an investor, I see sales going up like a rocket ship, but then I see earnings per share and it's actually a drag. How does buying a profitable business lower your earnings growth?
It's all about the financing and the taxes. First, they have higher interest expense because they likely took on debt to fund it. But the tax part is the really tricky bit. Before this deal, they benefited from something called a minority interest deduction.
Right, let's break that down because that sounds like pure accountant speak.
It is. Basically, before, they can tell the IRS, hey, we don't own this whole pie, so we shouldn't pay taxes on the profit from the whole pie.
And now they own the whole pie.
They own the whole pie, so they lose that deduction. And on top of that, the corporate tax rate in Mexico is actually higher than their average rates. They're making more operating profit.
But keeping less of it per dollar because of taxes and interest.
Precisely. It creates this dynamic where reported sales look amazing, up 12 to 16%, but the organic sales, the actual underlying business, is only growing 1 to 3%. It forces you to squint to see the real health of the business.
Okay, let's stop squinting at the spreadsheet for a minute and look at the actual grocery store shelf. Because despite all this financial noise, the CEO, Brendan Foley, he was incredibly bullish on the consumer.
And he has a right to be. This was the one unequivocal bright spot in the report. This was the 7th consecutive quarter of volume growth in their consumer segment.
That is actually wild.
Yeah.
Most food giants right now are playing the price over volume game. They're raising prices and watching the number of units they sell go down. McCormick is raising prices and still growing volume.
It shows real resilience. But we have to understand why they're growing. Foley used the term value-seeking to describe the consumer.
Which usually means people are trading down to store brands. But that's not what's happening here.
No, I think it ties back to the trade-off economy. If you're a household under pressure, the first thing you cut is the restaurant budget. You stop ordering delivery, you stop going out, you start cooking at home.
Right. And if you're cooking cheap ingredients, chicken breast, ground turkey, beans, you have to make them taste good. That's where McCormick wins.
It's the lipstick effect for your dinner plate. You can't afford the $100 night out, but you can afford the $5 bottle of smoked paprika or Cholula to make your meal feel a little more premium.
The center store spices are outperforming for that exact reason.
And they're seeing consumers make more frequent trips, buying fewer things each time to manage cash flow, but spices are consistently in the basket.
Foley also mentioned an interesting point on health trends. He said trends are shifting away from high carb, high sugar, and specifically alcohol. He flagged alcohol as a declining category.
That's a huge call out. It aligns with that whole GLP-1 narrative, but also just general health consciousness. People are eating more protein. If you're eating plain grilled chicken every night, you are dependent on seasoning. You're not getting flavor from sugar glazes anymore.
And they're trying to innovate into that. They mentioned this countertop-worthy packaging renovation for their gourmet line.
And it sounds trivial, but it actually matters. If the bottle looks nice, you leave it on the counter. If it's on the counter, you use it. If you use it, you buy more. It's a velocity play.
But there was a caution flag here. They said Q1 2026 might see some volume softness.
That's the elasticity check. They're putting new pricing on the shelf right now to cover those tariffs we talked about. And whenever you raise the price, there's that moment where the consumer might blink.
Let's pivot to the other side of the house flavor solutions, their B2B business. This felt a lot rockier.
It was a mixed bag, and it's kind of a canary in the coal mine for the broader economy. 2025 was tough for them. They cited inventory resets and soft volumes from large CPG clients.
And inventory resets is just corporate speak for our clients stopped ordering because they have too much stuff in the warehouse, right?
Correct. And soft volumes from CPG clients means if Lay's is selling fewer chips, they're buying less seasoning from McCormick. It confirms that while the home cook is doing well, the big packaged food industry is struggling.
But they did say the pipeline is healthy.
Doubled, they said, specifically with high-growth innovators. Think snack seasonings for protein chips, flavorings for nutritional drinks, again, chasing that health trend. But they were honest. They called the recovery lumpy.
So let's bring it all back to the investor. The stock gets crushed. Is this a buying opportunity, or is the market right to put McCormick in the penalty box?
The market derated the stock because the narrative completely changed. The story was supposed to be, inflation's over, margins snap back, and we cruise. This report said, actually, costs are sticky, tariffs are real, and we're spending a fortune on an ERP.
It's the classic problem of investors wanting jam today and management offering jam in 2028.
Exactly. Management insists they're on track for their long-term targets, but for now, they are in a heavy investment and cost absorption phase. The market hates that kind of uncertainty.
All right, we've dissected the earnings, the taxes, the tariffs. Now it's time for the segment where we stop being analysts and start being creative.
The "this is not financial advice" segment.
Yes, our standard disclaimer applies. We are just guys with microphones. This is for entertainment only. Do your own diligence.
Please do not sue us, so what have you got?
I'm calling this trade idea the Scoville stagflation spread.
The Scoville stagflation spread?
It sounds painful. Lay it on me. The logic is built directly on what the CEO said. Premise 1. Consumers are broke, but they still want flavor. They are dropping expensive habits like alcohol. Premise 2. Dining out is getting way too expensive, forcing a return to scratch cooking. And premise 3. McCormick now fully controls its Mexican portfolio, which means Cholula hot sauce.
Okay, I'm following the macro setup. You're betting on the shift to the home kitchen.
Exactly. So here's the trade. You go long, MKC. You're betting on the heat. You are buying the company that sells the flavor for the cheap chicken breast, the company that makes a sad recessionary meal taste happy.
Okay. And the hedge. What's on the other side of the spread?
You go short. High-end steakhouse chains and alcohol distributors. You bet against the sweet and the booze. Fully explicitly flag those as declining categories. If the consumer is value-seeking and health-conscious, they are not dropping $150 on a steak dinner.
They're buying a $5 bottle of Cholula and a pound of ground turkey instead.
That's the trade. You are longing the at-home reality and shorting the aspirational night out.
That actually makes a scary amount of sense. It's a hedge on a recessionary consumer who still has taste buds but doesn't have the disposable income.
It's the stay-at-home and spice-it-up trade. If the economy gets worse, the steakhouse loses, but the hot sauce wins.
It's cynical, but it is grounded in the data we just went through.
So there you have it, a really strong consumer volume story that was just completely overshadowed by tariff costs and a very complex acquisition integration.
Yeah, management is playing the long game with pricing and tech investments. But the market lost its patience today. They wanted a clean beat, and instead they got a construction site.
It's going to be a bumpy ride for a bit, but people have to eat, and they usually prefer their food to taste like something. Thanks for listening to The Deep Dive.
We'll catch you on the next one.